All right, now we're going to residual income part 2. Take a deep breath. Here we go. We're going to go through an example. In the words of Mr. Miyagi, your CFA is inside. Time to let out. All right, if you haven't seen Karate Kid, you should definitely go see it. I know you guys are all going to crane kick this exam. Here we go. So going through this example here, we have ROE of 20% per year for the next 4 years. And we have a book value per share at time 0 of $8. There's no dividends, so I don't have to subtract that from book value per share. And I have a required return of 15%. This is going to give me my equity charge or my fair return. And our forecasted earnings, by definition, book value per share, this kind of gets my EPS number. Now my continuing residual income after 4 years is going to be 0. So no additional residual income after that. So what we're looking for is intrinsic value. Keep in mind we're looking at approach number 1, right? So this is approach number 1 where residual income goes to 0 after the 4 years. Let's take a look. So we start with, you'll see here's my earnings per share. Each of these values, how do I find them? I multiply what? Book value per share for each period times what? The ROE. Now, where do I get the book value per share? I start with the $8, right? And I add each of the earnings per share. Now, there's no dividends, so I don't have to subtract those out. So I keep adding. So once I add that to the $8, I get $9.60. I add the next EPS. Since there's no dividends, I just add the EPS. I get to the next value, $11.52, so on and so forth, going all the way down. Now that I have all my book value per shares, I can calculate all of my EPSs in this first column by doing what? Multiplying by return on equity. Now, I also have my book value per share, so I can also find my equity charge or my fair return times the cost of equity or the required rate of return. And so as I multiply through, I get each of the values for my equity charge. Now, when I take my earnings or my EPS minus my equity charge, I will get to my residual income. Notice that's what they're doing here. So in that first one, I have 1.6 minus the 1.2 gets me to the 0.4. Another way to do it is I can just take the book value per share, multiply that by the difference between the return on equity and the required rate of return. All right, so what do we do with those residual incomes? Well, the first thing we do at time 0, we first have to have our book value per share. So that was what? $8. So that's going to be our first cash flow going in. Then we have each of the residual incomes for the next 3 years, right? 0.4, the 0.48. And then the last year, we also have the 4th year residual income that essentially goes to 0. So all I have to do is take the residual income, continued residual income after year 3. What I'm going to do is take that last residual income of 0.69, discount it back for 1 period. This brings it to time 3. So once it's there, I'm going to take it all the way back to time 0. And I'm going to add it to the last residual income for time 3. So I had a 0.57, add the present value of the 0.69 that went there. This tells me my last cash flow thereby is 1.17. Now, I stick it in my calculator using the required rate of return on equity of 15%. And this will get me to an NPV of 9.48. Just a couple things to note. Notice that it's majorly dominated by what? The $8 in book value at time 0. In approach 2, now we saw in approach 1 where residual income essentially goes to 0. What happens if we change to a continued residual income assumption, meaning constant residual income of 0.69 after 3 years? Now remember, that means the persistence factor is essentially what? Is essentially 1. So our residual income 1 plus the required rate of return minus the persistence factor, which is 1, right? That's the W. So what is left is just what? Just the required rate of return. So what we do is we include the present value of the residual income for years 4 essentially to infinity. And so how do we do that? We take that 0.69 and just do what? Divide by the required rate of return on equity. Then this becomes 4.6. What do we do with this 4.6? We stick it at the very, very end and then discount that back from year 3. So let's take a look. So we start with our $8 in book value per share, and right there in the beginning, we put in our first 2 years of residual income. Then we have our third year where we add our $4.60 to perpetuity. That gets us to a last cash flow of $5.15. We put it in our calculator at a 15% required rate of return. We calculate our MPV. Notice it's our highest value at $12.11 versus the lowest value that we saw when residual income goes to 0. Now, just bring it back to what we talked about as far as like the concept here, right? This type of firm here is saying that they can consistently sustain their competitive advantage. In the example before, we said that their residual income is going to 0. They are basically something like a perfect competition where they're basically just going to give you what? Just your equity charge or your required rate of return, nothing in addition to that after essentially year 4. Now, other things that we can do we have approach number 3, meaning that we change the residual income assumption in approach 3, that starting year 4, it will actually decrease to 0 with a persistence factor of 0.6. So unlike the previous example, instead of it being 1, it's now being 0.6. So notice here is my persistence factor of 0.6. So my continuing residual income in year 3 is $1.25. So what do I do with this? I add this to the residual income in year 3 and then discount them back. Let's take a look. I start with my book value per share at $8, my first 2 years of residual income. I have my year 3 residual income plus the continuing residual income with the persistence factor of 0.6. That is my $1.25 that I calculated. Add these two together, I get to my 1.82. Stick it in my calculator. Using a required rate of return of 15% gets me to an MPV of $9.91, right? So you just have to be very careful when you read the question, what approach are they actually taking, and that'll tell you what persistence factor essentially to use. Going down, so we have a multi-stage model that in this case, we're changing the continuing residual income assumption. At time 4, the price to book falls to 1.1. All right, so that means that the market premium is 10% over the book value. So in the future, the market is thinking that that residual income into the future is essentially going to be 10% over book value. So what I'm looking for is that continuing residual income in that last period. And so I know my book value from the table at that very, very end of the table. The book value at the very end is $6.58. Now, 10% over that is what? $8.24. That premium is $1.66. That means that over top of its book value, I have additional $1.66. So I take what? I take the residual income in the last period. I add in the present value of the residual income after year 4. I discount that back to year 3, and I'm going to add that to essentially the year 3 residual income, and this gets me to $2.04. Let's take a look at how we actually put this into our calculator. In our calculator, well, we have the book value of book value per share at time 0 at $8, our first 2 residual incomes. Then we have our third residual income plus the continuing residual income of $2.04. This gets us to a $2.61 after adding both of those together. Our required rate of return is 15%. We stick that in our calculator. I get an MPV of $10.43. All right, just kind of a review. We had basically 4 approaches, right? Approach 1 was residual income 1 plus R minus a persistence factor of 0. We had approach 2 where we had residual income 1 plus R and then minus 1, meaning this type of company is going to continue to sustain that residual income in perpetuity. This company perhaps had that competitive advantage to have that residual income. And then step 3, third approach, we have residual income where it would approach 0 over time, so minus 0.6. This is approach 3. And then approach 4, we just saw basically we looked at the market value minus the book value to find what was in addition, this market premium over book value. What was it in addition to its book value to find what the additional residual income into the future was, and then we discounted that back from year 3. So these are kind of the 4 approaches, just a review of what we looked at here. So, comparing residual income, dividend discount, and free cash flow models. So kind of putting all this stuff together. The dividend discount model and free cash flow models measure value by discounting a stream of cash flows. This includes your future and terminal values. Notice these are mostly backloaded, where your residual income starts with book value being very much front-loaded and adds this expected stream of additional return over your fair return or your equity charge and what we call residual income. And this can be either positive or negative. Now, theoretically, residual values should have the identical recognition values as discount cash flow. So both of these should technically give you the same value if the inputs used are essentially the same. But in the real world, this may not always be the case. So the strengths of the residual income model. These are you got to know these for kind of the word questions in your vignette. So terminal value does not dominate the intrinsic value because it's so front-loaded, right? Most of the value is coming from that book value per share up front. Accounting data is typically accessible because book value per share, you could just take the equity and divide by the number of common shares, and applicable without any dividends or positive cash flow. Nowhere in dividends is not dependent upon this, and applicable even when cash flows are volatile or unpredictable, because what we're looking at is return on equity against the book value and then the equity charge against the book value. And it focuses on economic profitability. Not just profitability, but economic profitability. How much are you making the investor over their equity charge or required rate of return on the capital that they put in. So, however, what are the weaknesses of residual income? First off, it's very much based off of accounting data, because the dominated number of book value per share in the very front is an accounting number, and it can be manipulated by management, and we'll talk about in detail on some of those. Requires a lot of adjustments. This is kind of a link to financial reporting and analysis and financial statement analysis. Assumes the clean surplus relation holds that its failure to hold has been kind of taken into account, still also in financial statement analysis. Basically, it means assumes no adjustment direct to equity. All you're doing is book value plus earnings minus dividend. But the problem is there are direct adjustments to equity, things that are in other comprehensive income that don't hit EPS, that don't hit, they're part of other comprehensive income, and we'll see those in detail in a second just as a review from your financial reporting and analysis. All right, so what are these accounting issues, right? So dominated by accounting issues, let's just talk about some of them. Well, while residual income is pretty straightforward, it does require these adjustments, the clean surplus relationship, meaning what? These direct to equity charges in OCI, off-balance sheet items, non-reoccurring items on the income statement, and any aggressive accounting practices. And like I said, international accounting differences, right? Through the financial reporting analysis, you learned about the GAAP and IFRS differences that can really make comparability really challenging between companies. So, clean surplus relationship violations. Here are your components and other comprehensive income. These are all in study session 5, 6, and 7. So the way I like to think about it, if you're ever in financial statement analysis, when I teach it, I always think about the mnemonic puffer. As you notice, I like mnemonics. So the mnemonic is puffer, right? These are everything that is in OCI. You got pensions, right? We learn about pensions. This is your prior service costs, actuarial gain losses that are in other comprehensive income, your unrealized gain loss on available for sale securities on AFS. That's basically, so we got our pension, we got our unrecognized gain loss, we got FX translation, right? FX translation. We saw this in temporal under the all current method under multinational operations, the amount of translation that goes to other comprehensive income. And then we next one is effective portion of a cash flow hedge. And then the last one is revaluation. Reevaluation to fair value. Keep in mind, this is only for IFRS. So I have foreign currency, balance sheet adjustments to fair value, and then deferred gain losses on cash flow hedge. Just so you know, the way I like to think about it, I usually draw a line right here for a puffer, meaning the R only exists for IFRS. So if you have trouble remembering this on test day for everything that violates the clean surplus rule, think puffer. However, in the United States under U.S. GAAP, there's only puffy, and then there's puffer for international IFRS. So if you have trouble remembering it, just remember the U.S. has Puff Daddy, the international they don't. Okay, so puffy for U.S., puffer for IFRS. Fantastic. All right, here we go. So the clean surplus relationship violations implications. The book value is correct because when you add up all the equity, you still have OCI in there. But the net income of the ROE forecasts are incorrect because they don't have these direct charges to equity, right? And the idea is that the issue of OCI items, they do not net items that don't net to zero, or the items that don't basically reverse over time. So what's our solution? Instead of using ROE, use comprehensive income. Recall, what is comprehensive income? It is net income plus other comprehensive income. So that way you kind of pick up the OCI. So, and you can see this is the income under clean surplus accounting, which is my net income plus other comprehensive income. And what is other comprehensive income? Puffer, right? Other issues with residual income, you also have off-balance sheet items. Some of these examples are going to need adjustments. Your operating leases. Look, operating leases are off-balance sheet. So what you're going to have to do is treat them, capitalize those leases and put the debt on the balance sheet, put the asset on the balance sheet. You have off-balance sheet special purpose entities or vehicles. Put those items onto the balance sheet as well. LIFO to FIFO inventory. Always remember, LIFO inventory is always good for the income statement, but you want what? You want FIFO inventory for the balance sheet. So what do you have to do? You take your, basically your LIFO reserve. And this is how you adjust your LIFO inventory to FIFO. So you're going to take your LIFO inventory, add on the LIFO reserve to get to your FIFO inventory. That way the inventory on your balance sheet is reflecting current prices. And this is nothing new. You've also seen this in study sessions 5, 6, and 7. I know you guys love that stuff. And then you also have your deferred tax assets and liabilities. And keep in mind, in some cases, if the deferred tax liability is not going to reverse, it essentially should be in equity. So, implications of this whole thing, book value may be misstated. You got to make these adjustments. Now, other things that you have non-reoccurring items as well. Some of these examples, discontinued operations. You don't want those in your particular balance sheet number. And you also have other non-recurring accounting changes in accounting principle and estimates, restructuring changes. You're basically trying to exclude any non-reoccurring items because they're going to taint your number as you run that residual income model. And they should be only based off of reoccurring items into the future only. Other things that you've also seen in financial reporting analysis, aggressive accounting practices, accelerating your revenue to the current period, or deferring expenses to later periods. Other things like using reserves to smooth income, things such as allowance for doubtful accounts. or unrealistic accounting estimates, right? Valuations of certain assets, depreciation life, allowance for doubtful accounts, so on and so forth. All of these are all aggressive, potential areas of aggressive accounting practices. So, then you also have your international accounting differences. These are difficult to apply to residual income in the international context with less strict accounting regulations. We're not, firms that are outside of GAAP or IFRS. So questions to consider: are the earnings per share actually forecast? Are they reliable? Right? Are they? Is the accounting reliable? Is the clean surplus relationship violated? Are there direct to equity that bypass the income statement items? Do the financial statements reflect economic reality? Look, there are a lot of things out there that, just because the accounting is showing it this way, but that doesn't really show economic reality. And then you really have to think about, what are some of the changes or adjustments that actually need to be made before you kind of plug those numbers into the residual income model. So what are the keys to the exam here? So you're looking at a lot of this stuff is going to be closely linked to the other material, especially in financial statement analysis. You also see in earlier chapters in equity, the Michael Porter's competitive advantage, 5 forces. Those all might be kind of linked inside. Some of the concepts will be linked here in the particular vignette. You're going to need to calculate residual income, doing the engine, right? Calculating the book value per share, then the residual income of each of the periods, and then calculate the value of the residual income model, and then looking at the continuing residual income at different persistent factor levels and different approaches. So also talk about when you actually are going to use the residual income, some of the advantages, disadvantages associated with, let's say, different types of accounting and aggressive accounting. So those are all things that this kind of vignette, you got to put it all together. Now, keep in mind that this is kind of one of the bread and butter ones. You really want to make sure that you know this, free cash flow to equity, and residual income. These vignettes are fairly, kind of must-have points that you're going to look for. All right, I'll see you guys on next class. All right, take care.